My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour, Eric Nuttall of 9 Points, going to be talking about his background and thesis on energy. So, Eric, for those who are not familiar with who you are, talk about your career progression, everything that you've done up to the point of what you're doing now, and what's your primary focus and expertise.
Sure. So I work at a company called 9 Point Partners. We're based in Toronto, Canada. I run two funds with AUM of just under 2.1 billion. The primary one is the 9 Point Energy Fund. I've been managing it for 12 odd years. I've been in the industry for 19 years. The fund was the number one energy fund in the world last year, as it was of conventional energy in 2019. And we're the largest energy fund in Canada. So that's a quick background.
Okay, now I've heard you talk about your experience working with Sprott. Talk through that a bit. I had Kevin Bambra, I don't know if that name sounds familiar, on one of these spaces not too long ago. But Sprott's an interesting firm, and Eric, I think, is a particularly unique personality. So talk through that experience for a bit.
Yeah, I started at Sprott in 2003, right out of school. I was hired by Eric and another manager, Jean-François Tardif, who is a really good money manager. Working with Eric was great. He was a really, really good mentor. I started off as a generalist, so just picking small cap, mid cap, U.S. and Canadian names. But it was a lot of the lessons that he instilled in me that helped me navigate through, the very, very dark depths of 2020. He was the highest conviction manager I've ever seen. Like, the guy was not afraid to take big, big positions so long as he did his work. Like, I helped him do the research, so we knew our stuff, and it allowed us to take advantage of drawdowns and add to positions and even as importantly, sit on your hands and let the stock reach levels that you think it should be reaching. So he was a really, really good mentor to have, and I'm deeply appreciative of my time with him.
What got you to move from generalist focusing on the energy sector in particular?
Well, Eric got bullish on oil specifically in 2005. I was originally hired to look at nat gas stocks at the same time in 2003, but Eric started believing in peak oil around 2005. Matt Simmons, Twilight in the Desert, etc. So he was a little early, but directionally he got the call on oil bang on. So we launched the Sprott Energy Fund in 2005. I took it over in 2010, and then we did a management buyout from Sprott. Sprott wanted to just be a gold shop, so they were selling all of the non-gold products. So we, instead of being sold, we bought it from them in a management buyout. And so it's the same continuity of the fund, same office, same floor, etc.
So you mentioned that conviction, right? And conviction is kind of an interesting thing in the investment industry, because conviction is what makes you, and hopefully your investors, very wealthy. It's also what can make somebody go through hell for a while, which we'll talk about too, right? And diversification is the antithesis to conviction, right? That you can't have conviction if you have a diversified portfolio to some extent. Talk about that early timing and launching that in 2005, because as you know, in this business of investing, you can be right in your thesis but wrong in your timing, and it's really just about surviving long enough to be proven right.
Yeah, like in 2005, a lot of the beliefs that Eric had around peak oil theory clearly did not play out. This was pre-US shale, which was not anticipated. There were some OPEC challenges at the time, but specifically like conviction. If I fast forward more to more modern day, when we talk about the conviction required to remain steadfast as much as possible through 2000, when we were all dealing with something that we've never dealt with ever before, like a global pandemic, specifically for energy, a demand shock that was many, 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 many multiples of anything we've ever seen in history. And so, I think that it segregates, or it's the distinction of a good money manager versus an average, where they have conviction in their names. And from my opinion, I can have conviction because I know what I'm doing. Like, in terms of the investment, I can do the analysis. Like, we have models internally. We don't rely on anybody externally to do it. So we've got everything modeled up from 70 to 120. Eventually, we're going to have to probably model a higher oil number than that. And so I can see very clearly what we own, why we own it, should we retain owning, what type of upside versus downside can we measure, et cetera. And yeah, conviction is incredibly important.
And it's important to know that it's different in terms of conviction when you are the man in the arena, right? Somebody that's running a fund versus an underlying clients, right? And I've heard you talk about that in a prior conversation that your fund went to, I believe, 20 some odd million in the depths of the COVID crash and then just went absolutely vertical since. I want you to talk about that period for a moment with the COVID crash when oil went to negative, what you were feeling and experiencing running that fund. But I want you to talk through that period in terms of, again, the conviction of the entrepreneur versus the conviction of the underlying investors.
I used the term soul sucking many a times during that period. It was truly awful. Like, not only are you incinerating your own net worth, but you're losing money at the fastest pace that you've ever seen. And there was a time where, part of it does feel like it's somewhat out of your control. You walk in and, it was over the weekend where Saudi officially got into a pissing match with Russia right as the pandemic was kicking off. It was like, okay, that was not anticipated. So I'm driving into the office very early. I know it's going to be a bad day. And so, we've got, got the fund open. We watched it at the open, and to watch a name like a Synovus, which is a large cap Canadian company up here, open down 50%. Other names like down 30, 40, 50, some small caps down 60% on the day. That was just the beginning of a multi-month journey on finding out just how low things can go. And so, yeah, it was extraordinarily challenging. My fund load at $26 million. It sits at 1.8 billion today. I give all the credit to my clients. I have the best client base on this planet. They are incredibly loyal. Part of that came from I really tried my best to inform, to say this too shall pass, and not just give false optimism or false hope, but like, this is why. This is the logic and the facts. And in that time that is still so fresh, like, people were you're paralyzed by fear because there was just so much uncertainty. But we looked at it, and again, we do all of our own work, so we'd be like, well, shit, like, here are names where they've got enough liquidity, they've got hedges in place, etc. But everyone is just so fearful, just everything's getting liquidated. And so we tried to turn that around to say, look, this too shall pass. This, when it does, if we're right, because it was based upon a forecast at the time, but we see the opportunity for generational wealth. And so you can take advantage of the fear and use it to your advantage. And it was funny. So I got a call from a Bloomberg report. It happened to be the day after the bond, like pure luck. But it's nice when a forecast can match up with what comes to pass. Like, in the interview, we said, well, look, like, we don't know when things are going to turn, but what we think is we can make like 400% from this time. And so we fast forwarded 1 year. I think it was 1 year from that interview, and our fund was up like 440% from that time. And so, yeah, it was incredibly difficult. I wouldn't wish that upon anybody. But my God, the lessons, the mental fortitude that made you do. Like, if I use the analogy of, like, I was the guy in a rowboat in the middle of the ocean, you're just seeing this epic black wall coming at you, and you can't turn around. And so the only thing you can do is strap yourself in, make it through, and if you do, then you're the last man standing, and you're going to reap all of the rewards. And I look at today. There's, in Canada, like, energy is a huge part of our economy. We're one of the largest oil holders of reserves in the world, and yet there's only 2 energy funds left in Canada. And so this is the time to be rewarded for, and my clients have been rewarded for the times that we had to live in March, April, and May of 2020.
See, I love this because I'm smiling as you're talking about this, because I present all over the U.S. at CFA chapters on these different research studies, and I always make a point to emphasize that we live in the small sample. Right, we live in the day-to-day, whereas markets live in a world of longer trends and secular cycles. And when you're living in the anomaly, and that anomaly is hell for what you're doing, the only thing you can do is keep going through that hell. Talk about that education component, because I'm kind of struggling with this myself now. You have to be continuously communicating and making sure that your investors stay with you during those anomalous periods, during those drawdowns. But it's really hard to get people to understand that investing is not about the here and now in a particular theme or strategy, but it's really about how that interplays with longer term portfolio management.
Yeah, I think the mistake that many fund managers make during times when things are going against them, when the call is not working out, when you're on your ass, and people think that if they hide, then their clients will not know how bad of a job they're doing in the moment. And I think that is just a critical mistake. If that was a philosophy that I adopted in 2020, I would not be here to talk to you. And so when you're doing well, clients generally don't want to talk to you, or if they do, they want to say, okay, well, how much more upside is there? That's a conversation I do have today with some clients, because I have some clients up 1,500, 1,600, 1,700%. And so it's trying to say, well, we still are very, very excited. We think stocks are more than doubles, et cetera. But the value add of a fund manager is truly on the days when you're just, the last thing you want to do is go on like TV. Like I would go on BNN, which is the Canadian equivalent of CNBC. And like when you're down 80%, when you look like the biggest clown in the world, where, you have to do top picks and stuff and they're down massively, the last thing anybody naturally wants to do is go on live television and admit that you're completely wrong in the moment. But that's when you add value to your clients. You have to remind them, why do they own what they own? Why is it a mistake now to lock in what I thought at the time was going to be generational, unrecuperable losses? But then at the same time say, look, this too is going to go, it's going to get better. This is why, though. It's not false optimism. It's just not false hope. This is logic and data and what we think will be fact. And this is why you can take advantage of that. And so I find like Twitter, like I'm the only manager I think in Canada really using it effectively. And it's a pain in the behind. Like, every tweet I have to do, it's got to be compliance approved beforehand. And, you think you got something good and then you get rejected and all these things. And it's a lot of work, but it's incredibly valuable to remind your clients, why are they in the trade? At times, like, this is a very volatile sector. You'll have headlines. If we just have Iran boarding a Greek tanker now and oil's up in such. And like, there's so much noise on a day-to-day basis. My job truly is to act as that filter for my clients and say, this is what matters. This is what I'm focusing on. This is what I would suggest you focus on too. Shut out the rest of it. There are days where oil's down 4 or 5% in a day. And I'll have a client call. I'm like, frankly, I can't explain that. Like, there's a physical market for oil, and then there's the financial. And the financial is 32 times bigger than the physical. And the physical is already the biggest commodity in the world. So it's just, is that noise or did something change? And so like that communication, like I saw on Instagram, there's an interview by Warren Buffett. And this is something Eric Sprott told me many, many years ago. And they both said the same thing. The best investment you can make is in yourself and making sure that you're an effective communicator, both written and verbally or on TV, radio, whatever, because that really, really distinguishes you as a fund manager. It's not just about performance. It's being able to convey the thesis in a manner in which is, understandable and has conviction, but it's also having the ability to remind people in the darkest of days why they should remain invested. That is critical skill, I think, for a successful fund manager.
This is really, I think, important for people when they think about investing in funds and investing in the managers of those funds. It's more than just sort of the theme here. Because, look, we're all human and we all go through drawdowns. Every strategy, everything has these periods where it's desynced, whether it's oil or risk on, risk off. And it's very discouraging. And Eric, I mean, just like you alluded to, it is a horribly difficult thing emotionally to go on TV when you're in the midst of a drawdown and to appear and be confident and knowing that people are looking at you or tweeting saying, you're a clown. What are you doing? Your strategy sucks. Well, you don't know what you're talking about. And it's all because everyone is so myopic in the short term and not realizing that, that's not really the proper way to think about putting money at risk.
Well, first you have to know what you own. And so I can look at all of my positions. And so I can say, okay, I own 14 names. On average, they're trading at 2 times enterprise value to cash flow at $100 oil and a 33% free cash flow yield. And I think they're discounting roughly $57 oil. So that's your starting base. And so then you've got to say, well, okay, the oil market, I think, is undersupplied by about 1.5 million barrels per day if you adjust for what I ascribe to be temporary weakness in China due to regional lockdowns. So then you're like, okay, well, what does that mean? For the market just to reach balance due to a loss of demand, it would require the global economy to hit zero growth, like not just US, not China, like global. And you're like, okay, well, that's only happened 3 times in modern history: 2020 from COVID, 2009 from the financial crisis, in 1982. which I was 3 at the time, so I can't specifically tell you what was going on, but it was inflationary times and rising interest rates, etc. So I don't think that recessionary fears like there, you'll get whipsawed around. First off, the people that are worried don't own the stocks that I own. They don't own the small and mid cap stocks. So at worst, you've got some of the large caps may get impacted. Eventually, maybe that does trickle down. But I think rationality will win at the end of the day when people realize that energy stocks broadly are discounting probably 60 to 70. I feel $100 is gonna act as a pretty good fundamental floor. So yeah, we're at the vagaries of the day to day when Nasdaq's selling off and you got margin calls and you need liquidity and it's easy to sell your winners in energy stocks. Like there were days when energy stocks were down 4% and oil was up. You're like, what the f is going on? Well, okay, it's just need for liquidity. So that's a short term risk that you've got to evaluate. Personally, and I'm going to sound like a perma bull when I say this, and people will throw rocks at me for saying so, but my own belief is we are in a 5 to 6 year bull market at least. $100 oil is going to act as a pretty good floor. And if you believe that, what that means then is any meaningful sell off is an opportunity to add weight or re-weight up. That's my own belief. I cannot find anybody that can justify $9 gas right now. We can point to LNG. We can point to global prices. We can talk to storage. We can talk to ongoing, discipline on spending of nat gas guys. We can talk about egress challenges. Marcellus bottlenecked. We can talk about U.S. shale oil not growing as much, therefore gas byproduct is not as much, etc. $9 gas is pretty eye popping. There's very few people that I think anticipated this level. And then I read on the plane. I was traveling in and out of Saskatoon yesterday, so you got time on the plane and reading the Gehring and Rosenzweig report saying, well, they think Marcellus is peaking. Fayetteville, the others that clearly have, and my God, North American gas pricing or U.S. gas pricing is going to reach global pricing in the next 6 months. It's like, wow, like that's tremendous. I still, until North America is better connected to the global pricing, I still think you're at the vagaries of weather because you still need either a hot summer or a cold winter to have an investment thesis. And so my conviction in that is lower than what it would be in oil, which we've called pretty well, where I truly believe we're in a multi-year structural deficit, meaning we need way higher oil prices. And then I can look to the producers and I can quantify on what I think is a reasonable level where I don't need, weather to justify that thesis. So it's more about, risk versus return that you're taking on. I can just have a hell of a lot more conviction in buying an oil name where right now I'm actively, as we speak, buying names like at 1.6 times enterprise value to cash flow and 32% free cash flow yields. They're debt free in 2-3 quarters. They're going to returning capital, all of those things. So unquestionably, there is upside in gas, there's upside in services, there's upside in oil. Everything is going to go up. It's just a question of, okay, I get money, like I had $6 million come in yesterday. Okay, where am I going to put that $6 million? Am I going to buy a gas stock at $9 where, you're hoping that the summer call is going to turn out? We're bullish. Or am I going to buy an oil name where I can just have way more conviction in the underlying thesis? So, gas names have done well. Like my fund's done okay this year, but I look at like a Tourmaline up 98%. We don't own it in the main fund. Like that's clearly cost me performance. I feel better where I'm positioned right now, which is in Canada, not just because I'm Canadian, but that's the most depressed valuations of anywhere on this planet. They're also the producer of the highest rated ESG barrel in the world. I'm invested in long dated assets where I'm getting decades worth of inventory for free, and they're committed to returning most, if not all of that free cash flow back to investors. So that's I still retain that stance. Everything's going to go up. The question is, how do I squeeze maximum upside relative to the risk that I'm taking on and the confidence that I can have in the investment thesis? So I do try to have mile markers to see, okay, are we seeing what we thought we would be seeing? The one tool that we use is looking at global oil inventories, because that's kind of like that's your BS detector in terms of whether you're right or wrong. Inventories, you have to account for why that is changing. But this was something I learned from Mike Rothman at Cornerstone, who's been a good a mentor, if I can use that word. I'm a client, but he's taught me a lot. So he believed, and I believe, that the best tool is gauging global oil inventories, because if inventories are falling, there's only one reason why: the market's undersupplied. Conversely, when they're going up, you're oversupplied, and there's a tremendous inverse relationship between inventory trajectory and oil price, as you would expect. And so we use a firm called Kepler to track onshore and offshore oil inventories. It's near real time. It's like 1 week data. It's expensive. It costs $100,000, but it's, in my mind, it's money well spent, because so that's something that we're keenly watching. And so you've had oil inventories fall by the fastest pace in history. It's like, okay, that's confirming our view. Well, recently you've got inventories building, so you got to say, okay, well, what's going on? So then you can say, okay, well, regionally that's occurring in China. You've got a temporary, I think, lockdown, and so it's not thesis changing, but that's what we, in terms of oil and the energy market. To me, it's not a demand story. Demand short term is dictated by economic growth. That's easy. Medium to long term, which hopefully we get into, there, all alternatives. The timeline for alternatives to displace oil use, that timeline is measured in decades. Like, nothing's going to happen overnight to kill my thesis. So it's all about supply. So long as Saudi, I think, spare capacity is becoming exhausted in the coming months. 8 of the top 10, producers were underproducing their quota in April. Saudi Aramco just came out and said, look, we're going to increase capacity by 1 million barrels per day, and it's going to take us 5 years. And yeah, we'd like to do it faster, but it doesn't work that way. Global super majors, they stopped investing in 2014. I had a great meeting with the analyst from Bernstein last week. They had met with the CFO of Shell the week prior. They're not even remotely close to contemplating increasing investment. And U.S. shale, I think hypergrowth is over. And so I'm always evaluating, okay, where could I be wrong? What are the key tenets of my call? And it comes about that demand will grow for at least the next decade. We will be consuming oil for the rest of our lifetimes. And then on supply, what are the 3 things I have to follow? Because there's only 3. U.S. shale is discipline holding, which I truly, truly believe, and we can get into that. OPEC spare capacity exhaustion, and then the global super majors. And that's it. If I boil it down, that's what I follow. But inventories are the number one thing that I follow, and I try to track in real time. And it's the best data that I can spend money on. It's been a 3-year campaign of mine to not change, but adapt the model of energy companies in Canada, similar to what's happening in US shale. And many of my US peers have been doing it since 2019. But my big belief has been, well, let's start off with energy stocks are trading near generational low valuations. I'm buying names at like 1.6, 1.7 times EV to cash flow. They used to trade at 8. Okay, so we've had massive multiple compression, because the average person is what I call energy ignorant, which is the polite way of putting it. They have no clue how oil is used and how long it's going to take to get off it. We will all be consuming oil for the rest of our lifetimes. And so, okay, if stocks are trading at generational lows, what can a management team do to change people's perception and make them care to get the stock going up? And so my belief was that as companies are now generating record free cash flow, the one thing and one thing alone that they should be doing that is giving it back to us and rewarding energy investors for going through the worst bear market in history. And so if you're meaningful, like we have the average energy company in North America trading at a 28% free cash yield at $100 oil next year. We're buying names in the 30s free cash yield. And so if you truly get to a point where your leverage is fine, like we have the average Canadian company being debt-free Q1 of next year, your long inventory, average company is sitting on 15 years of inventory. And so if you have enough inventory, you don't have to use free cash flow to go do M&A. You don't have to use your free cash flow to delever. And you don't want to grow because your owners don't want that. Like, we run the largest fund in Canada. And so by extension, I'm one of the largest owners of small and mid-cap companies in Canada on behalf of my unit holders. And so we have a say. Like, I own on average 5% per company. That's what I need for board representation if we needed to use that tool, which is something we never think that we'll ever have to do, because everyone is bought into it. So it's not just a large cap belief where Cenovus, Suncor, and MEG have all said, once we hit our final leverage metrics, you will get 100% of the free cash flow. We are always calling for 50% now, 75% once you get to your leverage metric. Use the 25 as you wish. But as companies come out with, 10, 15, 20% dividend yields, then my belief was, well, that will re-rate your share, your stock price from generational low valuation, so long as the market believes that that's sustainable. But if you're using 50% of your free cash flow at what I think is a floor oil price, and you're debt free, like that should be something that people can start to implicitly value in your stock. And so it's incredibly rewarding to see that coming about. And I would say it's a religion that's been adopted sector wide. I can only think of one company, one small cap that doesn't believe what we believe. And so that's incredibly important. And so, what's exciting is the difference between a cheap stock and a value trap. A value trap, you're cheap forever. A cheap stock, where if you can identify catalysts to result in the re-rating, Q1 earnings of this year was the beginning of that, and it's only going to get better. And think about Canada. We're long life reserve, we're low corporate decline, cost structures are low because we've gone through the worst bear market in history. The loonie is very low relative to the US dollar. So we're selling barrels near record levels. And yet our stocks, we're trading at like my fund average, I believe, is trading at about 2 times enterprise value to cash flow. And so I write a column for one of our newspapers up here. And the last column, the punchline was basically, why do more people not see what I see? And whether it's laziness, whether it's there's only one competitor left and myself to differentiate the opportunities, I truly do not believe that the valuations of today will last for much longer. I think people are realizing that we are very clearly in an energy supply crisis, and there is a profound opportunity in that.
I mean, I guess you can characterize that as laziness. I think we're in a world in general where there's so much reaction and less thinking. It's more system one, less system two, using the Daniel Kahneman kind of way of framing the way that people make decisions, right? Everyone simply looks at a chart and they never go deeper. And that's why nobody really has that conviction unless you're actually in the arena. Goes back to that point of the conversation.
So flow of funds is important. It's part of the reason why multiples have contracted from 7 to 8 times down to 2, let's say, like 75%. It's the reason why you can look at a $10 stock today used to be $40, 5, 6, 7, 8 years ago. Meanwhile, they're going to be debt free. There's the revenue is an all-time high, cost structure low, et cetera. So it's just the perceived value of the free cash flow stream of these companies. I actually personally I'm taking the other side of this. I think that the pendulum swung as bloody far as it could possibly go and is now starting to swing back. And the reason I believe that is that the invasion of Ukraine, I think, is a teachable moment, not just for energy policy makers, but it's an excuse for ESG investing to pivot back, because the world has made the connection that Russian barrels equals bad. Russian oil equals revenue that's being weaponized to allow them to buy cruise missiles that are killing innocent kids. And that connection has been very, very clearly made. And I will tell you, in Canada, speaking to extremely good sources, their inbounds are from European ESG funds saying, look, I need to get up to speed on the Canadian oil sands. Can you talk to me about it? Let me just make sure our numbers are right. And you're like, whoa, wait a second. You're an ESG fund. Why are you saying that? And the reason for that is that they are trying to see if they can fit Canadian energy stocks back into their mandate, which sounds extremely counterintuitive. But is it now ESG friendly to invest in non-Russian companies, so long as commitment to net zero by 2050, which we've made, et cetera? So the question I would pose to you is, well, why would they do that? Is it truly that there's that connection that has been made, or is it the performance anxiety being felt now by managers not long energy, which is by far the best performing sector for the past year and a half, I believe will continue to be, because all fund managers, all advisors suffer from the same critical weakness. And that is, I can be fired by the click of a mouse button in 3 nanoseconds. And the only reason why my clients don't do that is that they have conviction that I will continue to make them money. And so wokeness or not, ESG funds or not, they all suffer from that same anxiety. And so that's my own belief. And I can tell you that I'm seeing that in terms of fund of flows, in terms of conversations that I'm having. I do believe that you are starting to see the beginnings. It's early, but the very beginnings of a return of some of the funds of flow that left, that is coming back. And that will help these stocks trade back to more historical valuations. By far, the biggest bottleneck on oil companies growing supply are the very owners of those businesses, the shareholders. There is not an energy investor on this planet that wants oil companies to meaningfully grow their production. And the reason for that is that energy stocks, both in the US and Canada, more so in Canada, but energy stocks are trading at valuations that are disconnected from reality, in my opinion. And so I can tell you the conversation that I have as the largest owner of many of these companies is I strongly would prefer for you not to grow production. What I want you to do is maximize free cash flow and give it back to me. And in doing so, that will result in a re-rating in trading multiples from generational lows. I should not be able to buy companies trading at below 2 times cash flow when they have 30 years of reserves and are trading at 30% free cash flow yields. And so what will get rewarded? Because ultimately their job is to get their share price up and make their owners money. The best way to do that is to get a re-rating in their trading multiple by returning capital. It is not by growing oil production. And so we can talk about pipeline capacity issues. It's more of a Canadian issue. We're solving that somewhat with an expansion of a pipeline which is owned by Canadian taxpayers currently. But the biggest bottleneck, which is frankly great for the micro and great for the macro, it makes energy companies much, much, much more investable. And it makes the global macro meaningfully better because the roller coaster that I've been riding for the past 10 years has been US shale hypergrowth. This necessity to spoil the party every single time oil price rallies to go drill, baby, drill, and drill their brains out. The adoption of variable dividends completely changes that. The change of CEO compensation to no longer be aligned with absolute production growth completely changes that. This is a what will be a long-standing structural change in the ethos of these businesses. And so I think it's a mistake to focus on, the impact of White House policies and federal leases, and that is all noise. The biggest factor by far is energy investors want to get paid. They want to get rewarded for putting up with the agony of the past decade. They are now getting a taste of what 7, 8, 9, 10% variable dividends feels like, and they're not willing to give that up ever again. My favorite way to communicate to my clients is Twitter. It's something new, and the only reason I'm on Twitter is that somebody was posing as me and using it to pump stock. So I thought, geez, if I don't build a presence, and somebody else is going to, and now I get an imposter like every month, which is a real annoyance. But I like Twitter.
I think it's a compliment, Eric. Come on.
It's so annoying though. But anyways, Twitter is such a great medium to communicate in real time as much as I can. Compliance has to approve tweets and all that stuff ahead of time. I'm not allowed to reply, and so I've got a lot of rules to abide by. But yet, despite that, it's the most effective way for me to communicate both to clients and to potential clients, and I have recent success in that regard. And so it's an ability to circumvent the gatekeeper. I don't have to rely on an advisor to pass on the information. I can go direct to my end client and say, this is why you should be interested in energy. And you really use it as a sales tool, but you instill interest and you remind people either why they should care, or if they care, why they should continue to care. I like television because it's more, you can make that connection. It's that face-to-face. I've been doing it for quite a while. I do write a column every 2 odd weeks in one of our national newspapers up here. In Canada, you get a different audience for that. The paper that I write for is probably more pro-energy than some of the other mediums, but my goal there is to try to shape the narrative around Canadian energy to make people, to basically shed the light on energy ignorance, because the easiest way I can make my clients money is to drive that re-rating and share prices. And how do I do that? I do that by talking about the role of hydrocarbons, why we will be using them for the rest of our lifetimes, and therefore why perhaps you should be paying for more than 2 or 3 times for 20, 30, 40-year life assets where they're generating massive amounts of free cash flow and they've committed to returning most, if not all of it, back to shareholders. So I take a kind of all of the above approach, because I think each medium has different targets. But my favorite one by far is Twitter. And as far as I can tell in Canada, I'm the only one really doing it.
By the way, I'm glad you mentioned that point about the reply aspect from a compliance and regulation perspective. You'll have people that will say, "Why aren't you responding to me? You're ducking my questions." It's because you literally can't. Right? It's one of those things about the industry which is unique. And I will add real quick on that media point. To me, and I'm with Eric 100% on that point about Twitter as sort of the preferred avenue. To me, it's much more about tone, right? So the tone when you're doing a visual appearance on a TV program or on something like Real Vision is going to be very different than the tone on a social media network, where on Twitter, in many cases, the louder you are, the more retweets and engagement you get. And you're going to have to walk that fine line of message and how do you get it spread across in a way that people will pay attention based on the media. More of a different way of thinking about it.
I think the problem is so huge and getting so much larger that it's beyond the ability of supply itself to fix in the next couple of years. And so that's why I do think oil has to go high enough to kill discretionary demand and at the same time stay high enough and stay there long enough to allow the most woke of companies, of the epicenter be in London, to start investing in long cycle. And even when they do, you've got 4 to 6 years before you see a supply response. I think within OPEC, the data speaks for itself. When you have 7 of the top 10 underproducing their quotas in March, 8 of the top 10 underproducing in April, where you have the head of Saudi Aramco saying, we would love to add more capacity, but it takes time. My mind says, okay, well, they just said, okay, it's going to take 5 years to add 1 million barrels per day. Over the next 5 years, demand will, at minimum, I think, grow by 5 million barrels per day. Historically, it was growing about 1.4 million prior to COVID. Let's just use 1 million. So in the next 5 years, we need to add 5 million. Forget about offsetting base declines and all that stuff. We need 5 million. Saudi's one of that. U.S. shale, I think there's a few more years of 800, 900,000 barrels per day. And then that's hugely challenged because you've got Bakken and Eagle Ford at best flatlining. So you're really just leaning on the Permian. The global super majors, spending is only at 50% of 2014 levels. All of the mega projects sanctioned in the last bull market have come online. And as soon as they start spending, you've got 4 to 6 years. So the quantum of the problem, I don't think, can be fixed by supply alone. It cannot be fixed by Canada increasing by 100,000 or 200,000. It's not going to be shale, going back to an outspend model and taking away variable dividends and risking the ire of their owners and being fired and losing their $50 million per year jobs, all of those things. Like the quantum of the problem, we haven't even talked about Russia. Like the quantum of the problem is so massive that I just don't see a fix. And so if I am Saudi, I don't believe high oil prices accelerates the transition. I think that's complete garbage. I think anybody who actually spends time thinking about it and looking at the gating factors to speed of adoption would recognize that we could be at $300 oil. It's not going to increase the speed of adoption. How are we going to ramp up EV sales? Last year, pure batteries were 3 million. And there's 1.35 billion internal combustion engines in this planet, and it's growing every year. So the problem gets even bigger. Well, is $150 oil going to advance the increase in manufacturing to a point where you reach critical scale faster than 20 years? I don't think so. So when you sit back and contemplate just how big of a hole we're in and how it's been years in the making, I think it's going to be years in the fixing. So the average Canadian company, if they chose to, which I don't think they will, but they have the ability to be debt-free Q1 of next year. Most companies either want to be maybe debt-free in the small guys because the banks were terrible, terrible actors during 2020, or they want to be at a point where they're like half a turn of debt at $45 oil, which is effectively almost debt-free. So once they get there and they're sitting on average 15 years of inventory, I fully expect the model going forward to be low to no growth, maximum 5%, which means that there is a mountain of free cash flow to be returned back to shareholders. I don't think people appreciate truly how much free cash flow is being generated. Like we have sector average, the US skews this a little, but it's 28% in a sector that's debt free. That if you're long inventory, what do you do with the cash? There's only one thing to do: give it back. And so whether that's in the form of a dividend, whether it's base or variable, whether it's the form of a buyback, I've used a chart where I show, well, the average Canadian company can privatize and become debt free with 4 years of free cash. That's under that. It's about 3.6. I don't actually expect that to occur because that uses a static share price. I'm actually thinking my piece I'm going to be writing this weekend is, well, what is the power of the buyback? And if you use a market cap of 4 or 5 billion, well, what's the value of that last share? It's $4 or $5 billion. So you can drive the re-rating. You can force your share price to go up if you are a meaningful enough actor with that free cash flow. What's the role of governments? Like we just saw the UK enact the stupidest thing you could possibly do. Let's put a windfall profit tax on a mature basin where there's not a tremendous amount of drill-ready prospects, and we'll just squeeze them to goose, I think it was 5 billion or whatever, maybe that's pounds or dollars of revenue, to give back to consumers to rebate them for their energy demand. So you're goosing demand, and you're going to curtail supply because you're injecting uncertainty into a regime in an environment where companies don't want to spend anyways. So it's the law of unintended consequences. It's energy ignorance. It's idiocy. It's a combination of all of the above. I don't know where government's going to go. Like, I don't think there's any rumblings whatsoever in Canada of profit windfall taxes. It's something we try to spend time on with people with feelers into the federal government. It's not something that I'm worried about right now. I think at least in Canada, I think there's a recognition that we need all cylinders of the economy firing at full blast to dig ourselves out of the fiscal hole that we are in a post-COVID world. So I'm not worried about that right now, and I don't want to look out 5-6 years because every day is a new day, and we'll evaluate it then. My goal right now is communicating why do I believe we're in a structural multi-year bull market, and how do I make my clients the most amount of money that I can from that. So without getting name specific, what I will tell you is it has been a 3-year mission of mine, and it continues. Executives still suffer from PTSD from 2020, combined with in Canada, we just tend to be more conservative than US. So it means that you have to be a little bit more patient. But don't fool yourself to think that we are not going to get extremely meaningful returns of capital. Like my ask used to be 50 and 75, 50% now, 75% once you achieve your leverage metrics. Unless multiples re-rate, my ask now is 75 to 100%. And we've had 3 Canadian companies commit to that once they reach their leverage metrics. That is the model, I think, going forward. Until multiples re-rate to a closer to historical average, we use 4 to 6 in our targets. I actually think names will trade back to 7 to 8 versus 2 right now, but we'll dare to dream another time. But until we get a re-rating, in my mind, and again, I'm the largest shareholder of any mid cap, small cap company that I want to own. I'm generally the largest investor in them, and so we do have a say. And so don't confuse not seeing it yet with what I think I'm confident we will get. Some companies they're just a little more conservative. They just have to pay down debt in most cases, just that little bit more. But in the coming 1 to 2 quarters, I fully expect you to see much more aggressive returns of certainly Canadian small and mid cap companies, because we've already gotten it from the large guys. Like once you commit to returning 100% of your free cash flow, it's tough to ask for more than that. You're going to see that. I'm confident. I have to use language to get myself out of commitment there. It's in my opinion, you are going to see very, very meaningful action in the coming quarters, because we don't want to have to get more aggressive, but we have very friendly conversations on an ongoing basis with all of our existing holdings. And I would say everybody shares our philosophy that the easiest path to getting higher share prices is committing to a return of meaningful capital back to investors.
By the way, I will say on that PTSD point, I've made that point before, that generational lows tend to occur when you have investor PTSD. And you saw that clearly with the negative oil print. Anybody that's here, again, please make sure you follow Eric Nuttall, who's, again, as you can tell, very, very good at communicating. And I enjoyed this conversation quite a bit. Again, when you've been in the arena, you have a lot of respect for others that have been in the arena as well. So thank you, Eric. You're the man. Hopefully we'll be able to do this again soon. And thank everybody for joining. Cheers.